Assalamualaikum, everyone. Thanks for joining us tonight. My name is Nadeem, the portfolio manager for Sharia-Portfolio Canada. We're going to get started shortly, inshallah. Of course, the topic of tonight is how to build a Sharia-compliant personal pension plan. And we'll have our guest speaker, Jean-Pierre Laporte, presenting tonight. So we're just going to give it a few minutes, maybe about the next 2 to 3 minutes for everyone to log in. Assalamualaikum, everyone. Just a couple of more minutes till we get started. Again, thanks for joining us this evening. Wherever you are, we hope the weather is as nice as it's been in the GTA. So we'll get started shortly, inshallah. All right, maybe we'll get started. We always have, attendees coming in the early 5 to 10 minutes while we start. Again, Bismillah ar-Rahman ar-Rahim. My name is Nadeem. I'm the portfolio manager for Sharia-Portfolio Canada, based out of Oakville, Ontario. And again, thanks for joining us tonight. The topic of tonight's webinar is how to build a Sharia-compliant personal pension plan for your business and to maximize your retirement savings. With us tonight is our guest speaker, Jean-Pierre Laporte, who I will introduce in a second. But before I do that, first of all, we welcome, our returning webinar attendees, and at the same time, for some of the new people that are attending us for the first time, welcome, and we hope this is not the last time you attend our webinar, and hopefully it's just the start. So with that, I'm just going to say a few words on Sharia-Portfolio Canada, who we are, what we do. 1 second here. All right. So just a quick disclaimer. Everything that we say tonight is just for educational purposes only. We're not giving any investment advice. We obviously encourage you to speak to your financial advisor. We understand that every personal situation is different. And of course, if you're a client of ours, we encourage you to book a session with your advisor or myself. And, again, informational purposes only, and this is obviously a standard disclaimer. So like I mentioned, for some of the newcomers, who is Sharia-Portfolio Canada? Sharia-Portfolio, the parent company, is actually based in the US, got started around 2003 with our founder and CEO, Noshad Virji, based out of Orlando, Florida. Obviously, we're servicing the Muslim American community there, specializing in Sharia-compliant investing. Alhamdulillah, in 2014, the company really grew, expanded into about 26 states, registered with the SEC, and that's kind of where the growth really started to happen. Around 2019 is when we started to get the ball rolling and expand into Canada. The community here, the Muslim Canadian community here, is obviously growing, and it was definitely something that we feel, the community needed here. And by January 2020, we were registered with the Ontario Securities Commission as a portfolio manager. So what we do is we do provide that full service investment advice, and we do manage portfolios on a discretionary basis. Some of you might also know us by our sister company, SP Funds. SP Funds has currently 3 ETFs that trade on the New York Stock Exchange. SPUS, which is the equity, SPSK, which is the fixed income sukuk, and the third one, SPRE, which is the real estate REIT fund. So with that, now obviously it's 2023. Alhamdulillah, we've gotten a lot of interest onboarding a lot of clients across the country. We're actually currently registered in 4 provinces. And so, a little bit about myself. I've been in the industry for about 25 years personally, mostly in the private and wealth management space. Pretty much that's all I've been doing since I did my undergrad. So I've seen a lot of bear and bull markets. I've seen a lot happen in this world, and alhamdulillah, I'm still in the business. From time to time, I do contribute to the Islamic Finance News. That's a financial publication based out of the Gulf. And, I've also held previous roles at other investment firms such as Oppenheimer, HSBC Securities, Canaccord Genuity, Raymond James, and before joining ShariaPortfolio in 2019, I was with the Royal Bank of Canada. I have a Bachelor of Commerce from Concordia University in Montreal, and I am also a CFA charter holder. So as far as ShariaPortfolio, what we offer, I just wanted to highlight something. What are some of basically the menu of portfolios that we have. We want people to know that, we're not just here to screen stocks or to buy, to sell products. We tailor to any type of investor. So whether you are old and retiring, or you're young and you're just looking to grow your capital, we feel that, there is a solution there for you. And of course, we obviously recommend, speaking to one of us or one of the advisors or myself, as a part of the consultation. So with that, I'm going to kind of stop there and, present our guest speaker for tonight. His name is Jean-Pierre Laporte. And Jean-Pierre is a pension lawyer with 22 years of experience in the field of pensions and benefits. He's worked in some of the most prestigious Bay Street law firms such as Osler and Bennett Jones. He is currently the CEO of INTEGRIS Pension Management Corp and has held that role for a decade. JP is the father of the personal pension plan, or otherwise known as the PPP, and he's a frequent speaker across Canada. He's often quoted in the business press and co-wrote a course on the Pension for Knowledge Bureau, a financial educational firm from Winnipeg, Manitoba. For his contributions to Canadians, he was awarded the Queen Elizabeth II Diamond Jubilee Medal in 2012. So with that, I am going to stop right there and pass the mic over to JP. JP, take it away.
Yeah, thank you so much. And thrilled to be here tonight. Just want to make sure that everybody can see the slides that I have for our case study. Great, wonderful. So I'll be chatting about personal pension plans, of course, but if there are questions, please make sure to type them up in the question and answer chat function so that nothing gets missed, because to the extent we can, we'd like to make this a little bit interactive. And so here we are. Let's talk about personal pension plans. We have a case study that was prepared because I always find that it's easier for me to introduce subject matter that may be foreign to some by using a case study. So our agenda tonight is really to talk about, what are the primary goals, what are the facts of the case study, and then start talking about all the tax deductions and all the features of the plan. So by way of introduction, What I wanted to do is really showcase the power of personal pension plans as a tool to manage taxes, because the biggest destroyer of wealth is not the market, it's actually tax. If you bleed too much money to the tax authorities, you are in a really tough bind to grow your wealth and therefore be able to retire comfortably. And too many people, because they don't know anything about pensions, are making strategic mistakes in the way that they've structured their affairs. So I hope that tonight this will be of value to most of you. So tonight we're really going to focusing on, as I said, highlight the areas for tax optimization. How do we stop the bleed? How do we keep more of the money that we work so hard to earn? So let's get right into the facts, right into the weeds with our case study. So for the purposes of tonight, I've used a business owner that's right now 45 years of age and who would like to retire 20 years from now at age 65. The corporation that this business owner owns is producing about $1 million of before tax corporate income. But once you've paid all the expenses like rent and staff and so forth, the taxable corporate income that's retained is $500,000 or below. And I did that on purpose because I wanted this case study to be as conservative as possible. I could have used a higher taxable income and then that would have come with a higher tax rate and it would have made the solution look even better. But I decided deliberately to go with a very, very conservative approach. Now, this business owner needs about $150,000 a year to live because they need grocery money, they need gas money, etc. This owner has a 20-year-old child that could be put on the payroll, but maybe not. And you'll see how that comes in later on. It's a balanced investor. And the returns are roughly 5% per year. So he's not earning interest income, of course. It's just when you calculate the capital gains or the other types of income, this works out to 5%. Now, over time, remember it's a 45-year-old, the business owner has been saving some money through an RRSP. And again, the returns generated within that account were about 5%. Now, this business owner has had the business for 10 years, and every year to live, they needed to collect a salary of $150,000. The owner has no RSP contribution room left. They've exhausted it. Again, this is usually when we talk to many of our clients, there's always a little bit of RSP room. They don't always use it up, but here again, to be hyper conservative, we assume that there's no RSP room. And then with respect to the corporation, after all is said and done, there's still about $100,000 of retained earnings that are kept within the corporation. And what we did is that we assumed that this money was used to buy shares that are worth $100. The adjusted cost base, so the cost of the security, was $100 when they were bought. And they're kept inside the corporation's non-registered corporate investment account. So very classic. I mean, you can argue with the numbers, but this is what a lot of business owners that we see are. Sometimes the earnings are not as high, sometimes the salary is lower, the rate of return might be higher, but this is what we see. So this owner has to manage two things. They have personal tax to worry about and corporate tax. So they have a double sort of challenge. Let's see what this personal pension plan solution can do for them. Well, first and foremost, we have right away, right in the first year, in 2023, if we were to set up this solution, so the corporation would set up the personal pension plan on behalf of the employee. We would take care of all the paperwork. And there'd be 3 tax deductions right out of the gate. The first one is what we call past service. The second one is the current service. So that's the annual 2023 service or contribution. And the third one is the RRSP double dip. So that's one that often isn't well known. So let's look at what it means in dollars and cents. So in terms of past service, remember I told you that this business owner has had their business for 10 years. And each year they were collecting a salary of $150,000. So we can retroactively capture all those 10 years, figure out the costs associated with purchasing those years. And what I mean by purchasing the years, I mean, let's bulk up the size of the pension, because it's not going to be a pension based on 1 year of service. It's going to be a pension based on 11 years, 10 past year and the current year. Right? So we're increasing the size of the pension. And for that, there's a cost. So in this case, based on the math, this particular business owner, the corporation would be able to claim a $79,647 corporate tax deduction right off the top. Then, on an annual basis, for 2023, based on the salary of $150,000, they're also allowed to put in $30,480, which is higher than what you're allowed to do in an RSP. In the RSP, if you were paid $150,000, it's 18%, so that works out to $27,000. So we're above the 18% RSP contribution threshold. And that percentage, or that gap, this advantage, is going to get bigger and bigger all the way to retirement at 65. And then there's the RSP double dip. So not only is the corporation claiming a higher annual contribution for 2023, the $30,480, as an individual, this business owner is also entitled to contribute $7,500 in their personal RSP. And that, of course, will give you a personal tax deduction. So if you're paying tax at 50%, half of that is a tax refund. So when you look at it as a whole, the RSP person has a $27,000 deduction. Our customer has a $177,627 deduction in year one. So right away, you can see that this is a bit better. Now, remember that when I was talking about the facts, I said that there's $300,000 sitting in the RRSP. When we're buying back past service, meaning when we're recognizing those 10 years where the company paid a salary of $150,000, we're not allowed to ignore the fact that we have money in our RRSP. So what the government requires us to do is to transfer, in his case, with these facts, $256,000 from the $300,000, and that has to be transferred into the pension plan. The balance, the $44,000 that are still sitting in the RSP account, can stay in the RSP. That's one option, or can also be transferred into the pension plan, except that it's going to go into an account called the Additional Voluntary Contribution Account, or AVC. The $256,000 doesn't go into the AVC account. It has to go into the defined benefit account of the pension plan. And we call that a qualifying transfer. So what does that mean? What is exactly a qualifying transfer? Well, it's this RSP transfer that we were talking about. And the reason why it exists is because the tax authorities are trying to maintain some sort of fairness, equity amongst taxpayers. And the rationale is that if there wasn't this concept of the qualifying transfer, business owners would be able to load up on the RRSP their whole life and then set up a pension plan, and then again recognize all of these years and pretty much double dip and double their entire tax deductions for their entire life. And that the government has determined is not fair. So while they allow us to claim larger tax deductions than under an RRSP, there are limits. And this is why some of the cost of buying back past service has to come from RRSPs. Now, that's not the end of the story. So we talked about 3 contributions upfront versus the 1 RRSP contribution, but we've got more. So we've got what's called special payments, and we've got a smaller annual contribution called a PA offset amount, or pension adjustment offset amount. So let's look at what those look like. So before I tell you what those numbers are, I have to explain what I mean by special payment. Now, when you have a true pension, like a PPP, that promises to pay you an annual amount each year, broken down into 12 equal payments, the monies that are contributed by the company, by your own company, have to grow at a certain rate in order to ensure that there's enough money in retirement to be able to afford those promised pensions. And under the Income Tax Act, the government has determined that in order to make sure there's enough money in retirement, the contributions have to grow at a rate of 7.5% as a minimum. If you're not able to achieve that kind of rate of return, there's going to be a deficit that builds up inside the pension plan. And so what the law requires us to do is it used to be every 3 years, but now it's every 4 years. Every 4 years, we have to retain an actuary to take a snapshot of the health of the pension plan, look at the liabilities, what is being promised, and look at the underlying assets that ShariaPortfolio is managing. And then if there's a deficit, if the assets haven't grown at least 7.5%, then we're able to inject more money, which are called special payments. And these special payments are used to shore up the deficit, to bring the pension plan back into balance, meaning there's enough money now to pay off the promised stream of benefits in the future. You don't have that with an RRSP. If you max out, if you put your maximum RRSP contributions every year in an RRSP, and the markets tank, and you've lost, 30% of your money, that's too bad. Too bad, so sad. You cannot catch up. You cannot say, oh, I'd like to put more money, because you've maxed out. But under a pension plan, thanks to these special payment rules, the corporation has the ability to claim extra tax deductions. So that's very powerful stuff. So let's look at the case study. If you look at this table, you can see that every 4 years, there's an amount that's highlighted by these arrows. These are the special payments. So these special payments recur because, remember, we assume that the assets are growing only at 5%. And they should have been growing at 7.5%. So I have GICs here, but it would be something else, of course, that we would be using in a halal investments. The math is the same. So that's the special payments. Now, on top of that, we have other additional contributions, deductions, And this is the PA offset amount of the pension adjustment offset amount. So it's a little extra $600 that the CRA allows our customers to contribute to their RRSP every year, on top of everything else we've been talking about. Now, in this particular case study, it's a 20-year period, so about 19 years, about, well, 18 and a half years or so. That's another $11,548 that this customer is able to claim a deduction for. And of course, put that money to work inside the pension plan. I won't get into the history behind why that is. It's a little bit arcane, but just take my word for it. It's part of the package. Now, that's not the end of the story, because we also have other deductions, which you don't have with an RRSP. And the biggest one of the two is the fact that all the investment management fees that are paid to your portfolio manager are now tax deductible to your business. If you have an RRSP and, you know, ShariaPortfolio charges a fee, inside the RRSP, that fee is not deductible. It's prohibited by law. But in a pension plan, because it's not an RRSP, first of all, it's also a corporate deduction, because it's the corporation that's sponsoring the pension plan. It's a distinct legal entity from the plan member, the shareholder, the employee. So we're dealing with two different sets of parties, even though it's a bit of a legal fiction, but the corporation is independent of the shareholder. So the corporation, as a taxpayer, has the right to claim a deduction when it pays for these investment management fees. The fees that come to my company, to INTEGRIS, to set this up, manage it, supervise it, answer all the questions, blah, 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 those fees are also tax deductible for the same reason. Now, what I want to talk about is that because the fees are deductible, what that does is it reduces the cost of investing. It allows us to get to the end result without pedaling as hard. Okay, and it also triggers tax savings or sometimes tax refunds. So this is money that didn't exist before because it was dissipated in the form of taxes. Now, because we're able to claim an expense, we get to hang on to that money. So it's like we have our own little money printing press. And this is fun, and we'll see what it means in practical terms. But in order to help me do that, I have to make some extra assumptions. And of course, these are variable, right? So I assume here that, you know, Nadeem or the ShariaPortfolio would be charging 1.5% on the assets inside the plan. Maybe it's 2%, maybe it's 1.8, maybe it's 1.2, maybe it's 1%. It would depend usually on the size of the assets under management. But for calculation purposes, that's what I'm using. And then I've assumed, again, worst case scenario in terms of how powerful this is, I've assumed that the corporation is only taxed at the lowest rate of 12.2%. I could have used 20%, 26%, but I didn't. I just went bare bones so that I don't overstate the power of this feature. So if you look at sort of a breakdown of how the pension fund evolves over time from 2023 all the way to retirement in 2043, growing at 5%. And if we're using a 1.5% of assets fee, investment management fee, and then we take that and we deduct it from the corporate income and it's taxed at 12.2, it's either a tax refund or a tax savings. It's the same thing. In this case, $801 for the first year, and then it builds up as the assets build up. So when you tally up all the money saved by the corporation thanks to this feature, we're looking at $55,000 in change. Okay, again, remember, this uses a 12.2% corporate tax rate. If it was 26.5, it'd be over $100,000 in tax refunds or tax savings. But again, we always want to be conservative. Now, the INTEGRIS fees are also tax deductible. So over that 20-year period, when you tally up all of our fees, including sales tax, you end up with $49,199. But because all of that is tax deductible, again, using a 12.2% corporate tax rate, we get another tax refund of $6,000 and $2. Let's say $6,000. So pulling all of this together, there is a cost to being in a pension plan, $49,199. We talked about that. That's the negative part. But then we have $6,000 of tax refunds or savings thanks to the deductibility of these fees. And another $55,000. Remember, we looked at that earlier with respect to the investment management fees. So now we have $61,000 in refunds that we didn't have before because we weren't able to claim those deductions. Well, that's better than $49,000 cost. We're actually in the black by $12,000 after paying the fees. So that's why this solution auto finances itself. It triggers, it gives us access to tax savings and refunds that other people don't have access to because they don't have the legal authority to make these additional tax deductions. They're in the wrong plan. They're in an RRSP. They should have upgraded to a pension plan. So I love this feature because sometimes people say, oh, why do I have to pay you? I'm like, well, you know, we're not a charity. We do have to pay staff and actuaries and rent and, oh, okay. But, you know, when do I start making money? Because I don't have to pay you if I do an RRSP. And that's when we start showing them this. And then they go, oh, so you mean it's free? And it's actually expensive not to do it. I go, yeah, it's called an opportunity cost. Now, I'm not done with the deductions. I keep the best for last. So on top of everything that we've talked about, there is one final deduction that can be triggered if we decide to turn on the pension. And when I say turn on the pension, I don't mean give up and stop working and walk away from the business and retire. All I mean is stop taking a salary from one's business and substitute that with a pension from the pension plan. You can always take dividends as a supplement because you're still a shareholder. So all we're doing is we're changing the source of where the spending money is coming from, sorry. So terminal funding is a way to accelerate tax deductions in time without having to do it gradually year after year. So in this case, because this particular business owner decided to retire at age 65, we have the ability to do terminal funding to provide indexation to the annual pension, meaning that we're able to increase the size of the pension paid every year if there's inflation. So if you run the math, if you look at the actuarial tables, in this particular case study with these facts, the business owner is entitled to an annual pension of $188,980. But let's say there was like 10% inflation and we had done this. Well, now the pension plan would not pay 188, it would pay 207,878. It would increase the annual benefit because of an inflation adjustment. And the cost of providing this level of protection is, in this case, it varies for everybody, but in this particular case with these facts, the cost is $330,000 and change. So that's another corporate tax deduction available to the business. And some of you are probably thinking, yeah, well, you know what? Like, where's the money coming from? Right? Like it's good to talk about deductions, but how do I fund all this? Where do I get the money from? We'll get to that. But just for fun, again, with respect to my argument about this being auto-financing itself, the $330,000, if the corporation claims a deduction at 12.2, that's another $40,000 of tax savings or refunds that wasn't there before. So when you put it all together, this business owner could have maxed out, contributed to their RRSP, the maximum every year, and grown that money at 5%. I use 5% arbitrarily. I could have used a lower or higher percentage rate, but just for the purposes of having a conservative illustration. Had the person done an RRSP by age 65, 20 years later, they would have just a little bit more than $2 million to retire. And if you were to turn that into a pension, it would give you about $140,000 a year of annual pension. But by upgrading to a personal pension plan, because we're allowed to put more money, and this is excluding the terminal funding, that $330,000 enhancement, by age 65, this business owner has $2.8 million, almost $2.9 million inside their pension plan. So that's $855,000 extra that they've been able to stash away for their retirement. But the good news is that this person did not take additional risks in terms of investments, because we've assumed 5% growth, whether it's an RSP or a PPP. So this $855,000 additional wealth comes from the fact that we've been able to put more money to work sooner in a tax sheltered account. And instead of $140,000 under the RSP, this individual is enjoying a $188,980, which is $48,000 more each year than someone in an RSP, right? So that's a lot of extra spending money. But the advantages don't end here. Let's take that pension of $188,980 that I just mentioned that this business owner is collecting at age 65. The business owner happens to be married. Now, if you were to declare $188,000 in change on your tax return, you would have to pay roughly, I mean, I took this from an Ernst & Young online calculator, $61,687, okay? But because this is a pension plan, the law allows us to take 50% of that $188,000 pension and move it to the tax return of my spouse that is at home and doesn't have any income. She's looking after the kids. So now I only pay tax on half of that, because the other half has been moved to the tax return of my spouse by my accountant. So what happens is that instead of me paying $61,687, I'm paying $20,356, and my spouse is paying $20,356 because we both have the same pension income. It's 50-50 of the total. I didn't have to transfer a penny to her bank account. This is purely a paper exercise. I'm still collecting the full 188 on my bank account, well, minus the withholding taxes. But so when you add up what the household has to pay by way of taxes, we're talking about $40,712. Well, that's a heck of a lot better than $61,687. That's $20,000, almost $21,000 less tax that my couple or my household is paying every year. Remember, the annual fee, which is already covered, but even if it wasn't covered, my annual fee is $2,800. And I'm generating a $21,000 savings every year. Again, is this expensive? It's expensive not to do it. So then going back to my earlier point that I made about, wow, you know, JP, that's nice that you have all these deductions. and these ability to contribute. But where am I going to get the cash? My business isn't generating all of this income. Oh, I'm sure a lot of you are, but I'm just saying for those that are maybe just starting in business, startups. So where do I get the money? Because I don't have it from pre-tax operational income. Well, I'll remember in this particular case, we had told you that he had retained earnings of $100,000, and with that money, he bought 1,000 shares, each one worth $100. And he didn't sell them. Now these 1,000 shares have grown in value, and they're now worth $300 per share. And I come around and say, hey, it's time to, why don't you contribute another $300,000 to the pension plan? And so Nadeem gets a call, and Nadeem says, woo, isn't there going to be a big tax problem if I sell these shares? I'm happy to sell them, but you're going to have a capital gain, you're going to have tax in the company. So what happens in reality? So we sold the shares that were worth $100 initially at $300. So we now have proceeds of disposition of $300,000 cash, because we want to put that in the pension plan. That means we have a capital gain of $200,000. And the law says that only 50% of the capital gain is taxable. So there's only a tax bite, a tax problem on $100,000. But we're claiming a $300,000 corporate tax deduction by dumping it into the pension plan. So not only do we have no tax problem, we have $200,000 of extra tax losses that we can carry back 3 years or forward indefinitely against future income tax. So we've over deducted. We don't have any issues. But what I love about this is that of the $200,000 capital gain, 100,000 or the other 50% is now a credit to the corporation's capital dividends account, which means that if this person wanted to pull out $100,000 in the form of a dividend, it would land in their hands tax-free. In essence, we've almost created like our own little corporate tax-free savings account. We paid no tax by selling this property, and we've created the ability to yank money out tax-free whenever we feel like it. So pretty fun tax planning. Okay, we're almost done. So now I'm going to talk about a situation which may or may not impact some of you, but I wanted to cover it off. So imagine that this business owner that's now 65 decides to retire outside of Canada. And in this case, they're going to the south of Portugal, and they're going to use the pension, the $188,000 that's indexed to inflation, to live. As a non-resident of Canada, under Part 13 of the Income Tax Act, there's a flat 25% non-resident withholding tax at source, which works out to, in this case, $47,000. However, Canada has signed tax treaties with about 100 different countries. And those tax treaties typically say that instead of 25%, the tax is actually 15%, if it's legitimate pension income, which this is. So now on a $188,000 pension, he's only paying $28,347. So that's almost 19,000 less than the normal 25% standard withholding for non-residents. And as a little bonus, it turns out that Portugal doesn't tax Canadian pension income. So the only tax he's going to pay is this 15%. But one thing that anybody who has designs on becoming non-resident should keep in mind is that under the Income Tax Act, we have this concept of the departure tax, which is a special deemed disposition that taxes pretty much all your wealth one last time before you leave the country. Well, after you've left the country, but you have to pay the tax. Luckily for us and for our clients, there is an exception to that rule when it comes to pension assets. So in this case, this guy has $2.8 million in his pension plan at age 65. The full 2.8 million is now exempt from that departure tax. So I used a 25% tax rate. So we just saved him another $718,000 in taxes that he would have had to pay had the money been in other assets that are not exempt. Again, sorry to hammer the point, but is this an expensive proposition? If I'm able to save the client an extra $700,000 when they decide to cross the border, to me, it's more like a money printing machine. Now, remember I told you in the facts that this particular business owner has a child that's 20 years old. Well, if the child began working for the corporation and start collecting a salary, and this doesn't have to be a big salary, it could be minimum wage, it could be minimum wage part-time. But so long as there's a salary paid to the child, to the 20-year-old or 30-year-old or 18-year-old, whatever, that child can be added to the parent's pension plan. It becomes a communal account. And if the business owner were to pass away, here we assume the worst case scenario that on the first day of the retirement, when he's about to collect his first pension check, the business owner dies and there's $2.7 million inside of his pension plan in the defined benefit component, which is the one that he's sharing with his child. Well, because it's a pension plan and not an RRSP, we don't have a deemed disposition. We don't have to pay the tax. But everyone else in Canada has to pay the tax. So everyone else is paying at least 50%. Usually it's 53.5%. I just use 50% for ease of calculation. So most people would have to pay $1.3 million to the government because they're in an RRSP. But because this is a pension plan and because the child's part of the plan, all of it is considered surplus. And surplus doesn't get taxed. It just stays in the plan until it's pulled out, which could be 30, 40, 50 years later. So this is the most powerful tax planning feature of the personal pension plan. So to wrap up, because we need to save time for questions, what were the primary goals that we reached? Well, we have significantly more annual retirement income, right? An extra $48,000 a year than what the RSP could have done. We've also significantly increased how much wealth we have. It's not quite $1 million extra, but it's pushing there. And we've done all this by not dipping into our pocket because we're using CRA's tax money to auto-finance the annual costs of the pension plan. And if that wasn't enough, we've also protected ourselves if we decide to cross the border and become a non-resident from the departure tax. And if we're lucky enough to have the children work in the company and add it to the plan from the deemed disposition on death. And if we sell assets, capital assets like stocks or units of mutual funds or real estate, and there's a capital dividend account credit generated, that allows us to now start pulling money out of the company tax-free. So I think we've reached all of our objectives. And I just wanted to thank you for your patience and attention. So let's move back to Nadeem and to the questions.
Yes, thanks a lot, JP, for the presentation. We do have some questions coming along. So maybe I'll start with this one here first, because it's asked a couple of times here. What if the business owner pays himself or herself as a dividend, not a salary? Can you still use this approach?
No, unfortunately, when people collect a dividend, this is a right of being a shareholder. It's not something related to the employment relationship. And this is an employment pension plan. Therefore, dividends do not count, and we cannot use those. We can only use T for income, whether it's a salary and or a bonus. And just to be honest, it used to make more sense from a tax perspective to pay oneself a dividend, but that ended 8 years ago. And on January the 1st, 2014, the pendulum swung back in favor of salaries versus dividends on that day. But unfortunately, a lot of people didn't read the memo, or their accountants didn't tell them, and they're still doing full dividends. They're actually paying more tax when they're pulling money out this way. Because if you count the corporate tax plus the personal tax on the dividend, it's slightly higher than the personal tax on a salary.
Mhm. Yeah. Yes. You know, I got another one here. How about the new incorporations, startups who have not reached to the level of income described in the example? In other words, what's the difference between CPP and PPP, which we can do depending on the annual incorporation income?
So CPP, the Canada Pension Plan, is a public plan that you're pretty much forced to contribute to. The problem with it is that it's capped at a certain salary, which is very low. So it doesn't give you a big pension at the end of the day. If you want to go way beyond what the CPP provides in retirement, you have to layer on a PPP on top. You can't just live off the CPP. So the question is, does this make sense if I'm just doing a startup? Well, it depends. It depends, because if you do a startup that's going to fail and there's no money, well, there's no money for an RRSP, there's no money for a TFSA, there's no money for a PPP. There's just no money. So I would say don't bother. But if the expectation is that the business will pick up steam, then yeah, it makes sense to start early, because then you have the time value of money working in your favor.
All right. And again, I encourage everybody to use the Q&A box at the bottom to put your questions. Another question here. RSP tax deductions depend on the current income at the time of retirement. I guess that's a question, and then that shouldn't be 50% across the board. So that's, I guess maybe you want to answer that. And also, I guess, and I'll just add something onto this question. Would RSPs also count as exempt accounts on that departure tax?
Yeah, RSPs are also exempt assets from the departure tax for non-residents. The problem, but not the problem, but the issue is that, remember, my guy has 2.8 million, the guy in the RSP has 2 million. So the fact that you don't pay tax on 2 million is great, but wouldn't it be better not to pay tax on 2.8 million? You've missed on the exempt nature for another $855,000 because you're using an RSP. So both are exempt, but it's much better if you're in a PPP.
I think the question also was talking about the 50%, I guess, tax, you know, from the RSP. Depends on the current income at the time of retirement.
Well, so both pension income and RSP, well, it's RIF income, when you RIF the money out, right? Is ordinary income. Now, what I didn't tell you is that there is a $2,000 per year non-refundable pension amount credit that you can claim on your tax return if you have a pension plan or if you have RIF income. So you can claim that after 65. With us, you can claim it at any age. So that gives you a tiny little bit of tax relief. And then, of course, there's a pension income splitting. So yes, if I'm collecting $188,000 personally, I'm going to be probably in the 50% tax bracket. But if I income split it with my spouse, I'm going to drop into maybe a 30% tax bracket, because I'm only paying tax on half. So it depends. And then, of course, if I'm a non-resident, then I'm paying 15% tax plus whatever local tax there is, if any.
Yeah.
So it all depends. It's a lot of people think, oh, why would I do a pension? I'm going to have to pay 53% on first dollar. No, that is not always the case. It's usually not the case at all. But there's this perception that because it's ordinary income, you don't want to touch it.
Mhm. Okay. I guess a follow-up to the dividend one. If you switch from dividend to salary after X years, can you claim those years?
Yeah, any salary years. So let's say corporation started in 2010, and it was dividend, and then they did salary for a few years. They went back to dividends, then they went back to salary. We would drop off all the dividend years, and all the salary years would count for the purchase of past service.
Mhm. And how much salary would you require to go with this approach? And that's another question that we
Well,
have.
that's a good question. There's no bottom. Remember, this thing auto-finances itself, right? So it doesn't really matter. But realistically, and this is just sort of a quick anecdotal, we typically say, listen, if you can't even afford to pay yourself $60,000 of salary, maybe you're just not ready to save, period. Maybe you need every single penny for other things. So maybe come back when you've got a bit more salary that you can pay yourself. But for the children, so in the family context, I may pay myself 70,000. I can pay my son 10,000 a year. They don't need 70,000. They only need minimum wage. Because remember, on death, I want my millions to go to my son tax-free. And all they need is a salary, whatever it is. It doesn't have to be a big salary for everybody, just starts to make sense for me. At 70, and then it goes up. The maximum pensionable salary this year is 175,333. Beyond that, doesn't really make any sense to pay yourself more salary than that, because you can't contribute on the extra dollars above that.
Yeah. How much retained earnings are required to go with this approach?
It's not relevant. The retained earnings was just an explanation of, let's say you don't have enough active business income coming in because it's a dry year, but you have retained earnings. Well, you can look to your retained earnings to fund the plan. You don't have to use active business pre-tax income. It's just an illustration.
Gotcha. Okay. What about comparing the PPP to simply retained earnings in the corporate non-registered account and pulling out at retirement? I think.
Oh, that's a give me. I'm going to pay the person who asked that question.
Okay.
So,
all right.
so here's what happens. If you follow this advice, and I don't want to pick on the anonymous attendee who suggested that as a way of doing things, you're exposing yourself to 3, if not 4 taxes along the way. Tax number 1 is the tax that your business has to pay on the active business income. We use 12.2% in our illustration, but if you're above $500,000, it jumps to 26.5%. So this is the active business income tax for the corporation, tax number 1. Then you're putting the retained earnings, what hasn't been taxed, you're dumping it into a non-registered corporate investment account, and you're growing that money. Now, you could buy stocks and never sell them, but it's kind of hard to pick a stock and never sell it for 30 years, unless you're like Warren Buffett. So most people will derive income along the way. Not interest, but they will derive foreign dividends. Those are taxed at 50.17%. They will derive Canadian dividends. They might have capital gains. All of that is taxable. So that's tax number 2. So you're eating away at your wealth once at first, then on during the growth. If you have too much passive income inside your corporation, the tax on passive income that Minister Bill Morneau brought back in 2018 now kicks in. So you're allowed $50,000 of passive income. That's fine. But if you've been in business for a long time and you've got a lot of assets, a lot of investments, you're going to cross past that $50,000 of income. For every additional dollar of passive income, you lose $5 of your $500,000 small business allowance. So by the time you've generated $150,000 of passive income, you subtract the $50,000 that's safe, You're left with 100,000, multiply by 5. The entire $500,000 small business where you were enjoying a 12.2% tax rate is gone. On every dollar of active business income you're earning, you're paying the full 26.5%. So as your tax rate has gone up by 117%. So that's tax number 3. Okay. Plus the tax you have to pay on your active business income.
Yeah.
So now you say, okay, as the blog says, now I want to start drawing money out of, I'm treating my corporation as if it was a pension plan. I want to take a dividend. So you declare a dividend. Well, you have to declare the dividend in your personal tax return and pay tax a 4th time. So we're up to 4 taxes on this money. What I suggest is don't pay tax number 1 because you get an offsetting deduction when you put the money in the plan. Don't pay tax number 2 because it's a tax exempt pension plan. Now, because the pension plan is not an asset of the company, it's an asset of a pension trust, it's not caught by tax number 3. It's not passive income. So you don't have the $500,000 grind, losing and exposing yourself to an increase in corporate taxation of 117%. You avoid that as well. The only tax you're going to pay is what you're collecting in retirement on your annual pension, which we've seen could be as low as 15% if you're a non-resident, or 30% if you split it with a spouse. Wouldn't that make more sense to pay 1 tax 30 years from now at 30% than 4 taxes along the way? I don't know, but
and of course the estate benefits of it.
Well,
right?
that's on top. All that is on top. I'm just saying, just as a pure spreadsheet analysis, my strategy is 1 tax 30 years from now or 20 years from now. Your strategy is tax upfront, tax along the way, tax if you have too much passive income, and tax when you pull it out. You tell me who's going to end up with more money.
Yeah, exactly. All right. Maybe this one final question, just to kind of sum it up. I think this is the perfect question. As a business owner who isn't as knowledgeable in the investing space and doesn't have the time to necessarily keep up with all the ins and outs of this plan, can you explain what the process would look like with ShariaPortfolio and INTEGRIS? What would the process be to start? What would be the relationship look like throughout until retirement? So maybe I'll begin, and JP, you can jump in as well. We've done numbers of webinars on a variety of topics, and of course, retirement planning is one of them. And I always kind of explain that the RRSP is just a pot, and and what you put in the pot is what we do as portfolio managers, and we manage that. The PPP is another pot. And I think the relationship really starts with INTEGRIS kind of, I would say, kind of, building the pot or getting the details of the pot. And then ultimately, we as portfolio managers, we're there to manage that investment within that context. So I'll kind of stop there, JP, and let you, finish up with that.
Yeah, I mean, those are all fair points. And the way it would work, practically speaking, is you'd contact Nadeem. Nadeem would gather some information. We would then put it through our software to get the equivalent results. We'd have a conversation. We'd answer all your questions, talk to your lawyer, talk to your accountant, make sure everybody's on board. And then we move to registration. We set up the plan. Once the CRA gives us the letter saying you're good to go, come back to Nadeem, and Nadeem opens up the accounts, and now we can start funding the plan, dump it into that bucket, and start growing it.
So basically, how to start? I put my information out there on the slide. So definitely do reach out to me. You can set up an appointment. We can have that initial consultation, and from there, INTEGRIS will. You guys, JP, you can confirm this, but you take that information and you do develop a quote, correct? And
an illustration, a quote to show all the advantages that we've been talking about, so that you can quantify them with your facts, not some case study, but your particular facts. what is it that you're missing out on because you didn't know that you could upgrade to a pension plan? So we want to figure that out first. And then if the delta of the extra wealth net of fees is massive, then the only logical thing is to sign up and set up the plan.
Yeah.
Unless
Right.
you prefer to pay taxes, in which case stick with the RSP.
All right. Well, again, thanks, JP, for your time and for the information that you shared. We hope all the attendees that were on, at the very least, enjoyed this information and found it very informative. As mentioned, if you have any questions, if you'd like to get started, please do feel free to reach out to myself, and we'll take it from there. So again, thanks again, and thank you everyone for joining. Assalamu alaikum.